Hi everyone, this is Ted Bauman here with your Friday video comment from me. Today I want to talk about Tesla. Tesla has really been on a lot of people's minds recently. I mean, it's gone on a tear, hasn't it? Certainly there have been a lot of people talking about it here at Banyan Hill. We've had some of our guys have earned quite a bit of good returns on it because they bought options, call options on it, and they turned out really well. Let's start with a fact about Tesla. I want to show you a chart. This shows the overall approach taken from a representative sample of writers about this company from a popular financial website. But look at the pattern there. It's all over the place. There are people who love it. There are people who hate it. There are even people who are neutral about it. The point I'm making by showing you this chart is that this is not a company that everybody agrees on. Now, why is that? Well, first of all, let's get over the first hurdle. What's happened with this company stock? I mean, we just saw it hit a high of $940.13 after having started the year at around $418. At that price, its forward price earnings ratio would be around 113, which is extraordinarily high. It means that at its recent price point, Tesla would be one of the most excessively valued companies in the world. So clearly, the attraction is not based on the current profitability of the company. It's based on what's happening in the future. Now look at this chart that shows what's happened to this price. Basically, at the beginning of this year, this stock just went absolutely nuts. It was trading in a range between about 200 and 300, and touching on 400 for a couple of years, and then all of a sudden, at the beginning of this year, it just took off like a rocket. Now, more recently, I'm going to show you this chart that shows that there has been a significant pullback in the price. Oops, for anybody who bought the stock at over 900 or around 900, it's pulled back significantly, and the reason for that is basically the problems in China. The coronavirus means that Tesla has had to slow down production at its new factory in China, which is going to be competing to sell those cars into the Chinese market. So that's caused a pullback in price, but I would argue that it's not based on, again, a realistic assessment of profitability and all those sorts of things. It's really sentiment driven. Now, let's look at a third chart that shows the recent action in not just the share price for Tesla, but also short interest. Short interest is the number of shares that are borrowed by people who borrow shares, sell them at a high price, and then bet that the price is going to fall, and then buy them at that lower price and return them to the borrower or to the lender and make a profit. So as you can see, the rise in Tesla's share price over the last couple of weeks has really tracked the drop in shares outstanding, the short interest, which tells us something. What it tells me is that part of what's going on with Tesla right now is that shorts, people who had bet against the stock, are rushing to buy it so they can cover their bets. And when that happens, it's called a short squeeze. It doesn't mean that the stock is necessarily worth the price that the market is currently trading. It means that people have to buy it, because if they don't, they'll lose even more than they already have. Now, there's another set of reasons to be cautious about the current pricing of Tesla. One is just the enormous amount of retail investors who are buying the stock based on recent headlines. In fact, that's something that we've been talking about here at Banyan Hill. We looked back at the Bitcoin experience, and we looked at, like the dot-com experience in the late 2000s. And, we basically realized, well, this is a similar pattern. People hear about something, then FOMO starts, fear of missing out. Everybody wants to buy it. Well, it struck me that there's been a rush of new investors on platforms like Robinhood, where you can buy shares for, basically with no fees, and you can buy fractional shares and all that sort of thing. On Monday this week, 12,000 people on Robinhood bought Tesla for the very first time. And a lot of people have bought into this company at over $700 a share. So that tells me that in addition to the shorts, who have been trying to grab as many shares as they can to avoid losses on their shorting activities. You've also created a short-term rush to buy the company, which has also pushed up the share price. There are other factors as well, and this is something that you're not seeing very much in the press. One of them is that in the United States and Netherlands, which are the two biggest markets for the current Tesla production, starting this quarter, the first quarter of 2020, the current incentives, the tax breaks that people get for buying an electric vehicle are going to start decreasing. And so during the fourth quarter of last year, when Tesla was able to report positive earnings, part of that was because people were in a rush to buy these vehicles before the incentives expired. So a whole bunch of reasons why the share price has been driven up in recent weeks. Now, my overall take on this is that at the moment, this company is badly overvalued. It is not a company that you should buy right now. I'll talk a little bit more about when and if you should buy it in a moment, but the key thing is that if you are experiencing FOMO, fear of missing out, don't try to buy this this car company right now. Remember, this company lost $862 million last year, and it has never posted an annual profit in nearly 20 years. Now, there are a number of reasons why I think you should be cautious. That's the first one, that this company has not been profitable in the past. But the other one is that if you look at the actual growth in revenue, which is basically the growth in how much money they brought in through sales in the fourth quarter of last year compared to the fourth quarter of 2018, revenues only grew by 2%, right? So what we saw, I think, with Tesla's brief break into positive territory on an earnings per share basis was that they had managed to reduce costs. As Clint Lee and I spoke about recently when we talked about Tesla briefly, I emphasized the fact that I thought that it was their ability to reduce costs in their production activities that had actually contributed to this, which is a good thing, but it's not a huge, it doesn't represent a huge growth in sales of the vehicles. And I'm going to talk about why that is so important in a moment. Now, I think part of the issue with the slow growth in revenue for Tesla in the fourth quarter of last year was that there's been a trend away from their more expensive earlier models towards their cheaper model, the Model C, which is designed for ordinary people like you and me. Now, the margins on Model C are a lot lower. So even though Tesla's sales increased and they managed to increase their earnings per share into positive territory, part of what offset that was a shift away from the high-end vehicles to the low-end vehicles. Not necessarily a bad thing, but it does mean that you have to look under the hood, as it were, to understand that although Tesla did break into a profit, it's not necessarily a sign that they are on track to do what they need to do, which I'm going to describe in a moment. Now, the second thing I think is it's important to understand that Tesla is a long way from being a company that can actually produce anything like a dividend or any kind of positive earnings for the people who own the shares. Now, there are basically two reasons to own shares. One is because you expect that company to produce a profit and to pay you a dividend. And the second reason is because you expect that company's share price to increase because of something. And we are at the moment in a case where this stock is all about the story. So people are buying this stock in anticipation of future increases in its share price. They're doing it partly because they're being told the story that the company will eventually become profitable and dominate world auto markets. But at the moment, that's so far away that really what people are doing is speculating on this company's stock. That's not necessarily a bad thing either. But I think the critical thing is if you are speculating, speculate at the right entry point. And I don't think $900, even $700 for this company is the right entry point. So let's return for a moment to the question of margins. And here I want to show you a chart that shows Tesla's revenue in terms of its year-on-year growth in revenue versus its profit margin. Now, as you can see, over the last 3 or 4 years, Tesla has experienced some rapid growth in revenue. But last year, the year that everybody's excited about, revenue actually declined year-on-year for the entire year by 7.63%. And the reason for that, again, is because they have shifted away from the higher priced older vehicles, the luxury vehicles, towards the Model C, and that brings in less money because they're cheaper cars. So if you look at the gross profit margin, again, it's declined from 28% back in 2015-16 down to just under 17% today. Now, I think this is where we need to recognize that Tesla is not the only game in town. What I've described to you is a case where Tesla is moving away from higher priced, higher margin, higher revenue per vehicle cars and is moving towards lower price, lower margin, lower revenue per vehicle cars. It's selling more of the latter and less of the former. Now, one of the reasons why Tesla is moving in that direction is because people can't afford $100,000 or $80,000 high-end vehicles. We need a mass market electric vehicle. But here's where Tesla is going to start facing competition, and that could well come from China. Now, right now, China is in lockdown. We know that. So this is all speculative at this point. But we know that the Chinese government is very keen on developing its own electrical vehicle manufacturers. It has subsidized them heavily. It is aiming for the same segment of the market that Tesla is with Model C. So Tesla right now has already seen declining revenues and margins over time because of its move into this mass market, lower priced product area. But that's where they're going to start running into competition. At the higher price levels, nobody was competing with them. Now you're going to start seeing other vehicles or vehicle makers, particularly from China, start trying to cut into Tesla's market share. And I'll talk about market share in a moment. Now, one of the other things I think is worth noting is that over the last 12 months or so, Tesla insiders, company executives, and so on have sold 4 times as many shares as they bought. Just in the last 3 months, those insiders sold 100,000 shares of Tesla and didn't buy any. Now, whenever that happens, that tells you that those people think that the company is already at a high price point and they want to cash in while the going is good. I don't necessarily think they saw this big spike coming. They probably would have held on, but they didn't. And you have to take that into account. That means they know something. And I think what they know is just what I described, that as Tesla moves down market and more mass market, it runs into more competition, which means that this current euphoria over earning positive money in the third and fourth quarters of last year could actually come to an end fairly quickly. It's also worth noting that the Saudi Arabian sovereign investment fund sold all their shares last year before this run-up in shares. Now let's talk about the last big issue, I think, and this is where I think it all ties together. I want to show you a chart that shows Tesla's current status vis-a-vis the rest of the market. In other words, vis-a-vis all the car makers in the world today. Right now, Tesla is at the absolute bottom. It barely registers in terms of the number of vehicles that it is selling. The critical question here comes back to something that a lot of people have been talking about. We may see a scenario fairly soon where the number of cars sold every year actually begins to decline. They call it peak car. Now, what that means is that everybody who can afford a car and wants one has either got one or has decided that they can do with some other kind of transportation option. Now, when a market is growing in terms of the number of products that can be sold, all manufacturers in that market can grow and expand their market share at the same time because they're chasing more and more buyers. Under the current scenario, though, if we have reached peak car, that means that the companies have got to they can only grow market share by taking share from each other, right? So here's Tesla. What this chart is telling us is that in order for Tesla to continue its growth in vehicle sales, it needs to take market share away from other companies like Volkswagen, Toyota, GM, Renault, Hyundai, Ford, etc. All of these companies are, in a sense, the targets for Tesla right now. That's why Tesla is making cheaper vehicles. It's why it's making the Model C. It's why it's making the Model Y. Because that's the kind of vehicle that these companies are selling with internal combustion engines. The problem is that as Tesla does that, it may increase its volume of sales to catch up with these other companies. The question is, can it increase its margins on those sales? Because if it cannot do that, it means that it won't be able to increase its profitability and its earnings per share because it's becoming a typical low a low margin, high volume, mass market automaker. So the overall lesson that I'm giving you today is that Tesla is a company that is certainly breaking new ground. It has broken new ground. It's doing exciting things. I'm impressed with their battery technology. I'm impressed with all the kinds of things that the company's done. I like the design of the vehicles. I've seen them. I've never ridden in one, but I like the way they look. I've even thought about maybe buying one myself. But the bottom line for me is that the investment case for Tesla is still uncertain. And that's because the idea that this company is going to become the dominant producer of automobiles around the world and take market share around all these other companies, many of whom enjoy support from home governments, and particularly also the Chinese up-and-coming low-cost electric vehicle manufacturers. That means that Tesla is still facing a lot of headwinds in the real world. Not headwinds in the stock market, in the real world. So my advice would be, if you want to buy this company, buy it, I think, at the price points that it has been trading around for the last 3 or 4 years, which were based on this kind of analysis that I'm giving you, saying, the company is trying to prove that it can do something. That something is not producing electric vehicles. People can do that. That's happening in a lot of places. The thing that Tesla is trying to prove is that they can do that profitably on a per vehicle basis. Now that means that really you should be looking at trying to pick up Tesla for around $350, which is frankly a lot lower than it is trading right now. In fact, that implies a 50% drop. Personally, I wouldn't buy it at current prices. I think people who have been celebrating and popping champagne corks about this run-up, they know very well that this is about external factors. It's about the FOMO effect, the fear of missing out. It's about the shorts. It's about the hype that Elon Musk and his company is deliberately trying to push to overinflate the importance of the last couple of quarters of positive earnings per share. The real test comes for any company when it is producing markets for a mass market where the economics of each unit sold provide a profit on a sustainable basis, and they're able to take market share away from their competitors. That is a bridge that Tesla still needs to cross. That doesn't mean I'm bearish on the company entirely. It means I won't buy it at the current price point. I want to see it drop by at least 50% or more before I would plunk any money down on that stock. So there's Ted Bauman, me, with my take on Tesla. Remember, I'm not a bear on this company. I'm just a smart investor looking for the right time to buy. And certainly buying at the very peak of a crazy run-up is not the time to do it. I'll see you next week. Have a good weekend.